Welcome to Liberated Stock Trader. Learn stock market investing. My name is Barry Moore, Certified Financial Technical Analyst and founder of LiberatedStockTrader.com. In this episode, I'll cover the topic of 11 core tips for stock options trading success. Recently, I received an email from a registered student regarding stock options. He asked me, "Do you have a system that can help me make money in stock options?" He had invested in his training, but the training was mostly about how to follow a specific stock option system. My reply was, my advice to you is to invest in your education so you can truly understand how to evaluate stocks and how to make decisions on future direction of a stock. Also, before you use options, you need to be able to make money with regular stocks. Options have risks, time is always against you, and you need to be able to judge the direction of the stock market as well as the direction of the individual stock. Let's take a look at trading stock options. Here's a simple example. Stock options are simply a vehicle to achieve a goal. For those people who cannot use leverage to increase their total investment pot, options are a cheap and effective way to leverage your invested capital. For example, I have $1,000 to invest. Strategy 1 could be to buy the stocks. So I could buy 5 shares of Amazon at $198 per share. The total cost would be $990 plus trading costs. Now, if Amazon moved up 5% over the next 2 months, that would be to $207.90. My profit would be $9.90 per share, which equals $49.50. My second option would be to buy the stock options or buy options on the stock. I could buy one out of the money call contract for Amazon with a strike price of $200 and an expiry date of 2 months from now. In options speak, that means one contract is I will have control over 100 shares of Amazon. Out of the money means that the strike price of $200 per share has not been reached. The strike price is the point at which the option will have value, apart from the time value. The expiry date is a date on which the option contract expires and loses all value. So in the same scenario as above, the stock price moves 5% to $207.90, and the difference in price is $9.90 per share. My theoretical profit would be 100 shares in the contract times $9.90 equals $990. This essentially means a gain of 100%. I say theoretically because when you buy an option, the clock starts ticking on the time value. If the stock price took 2 months to move to $207.90, then you would have lost all of the time value in the contract, which would dramatically reduce your profits. However, if the stock had moved 5% in one day, you would have secured almost all of the 100%. So what are the risks of options compared to simply buying the stock? If the stock price moves against you, you can lose your entire investment. So with options, if it doesn't start moving, you can lose your entire investment. But with stocks, this rarely happens. So let's move on to our 11 core tips for stock options trading success. Tip 1, understand technical analysis. Before trading a single stock options contract, you need to understand technical analysis. Not only that, you must have a strategy that pays off. This means you must have already developed a profitable stock market strategy through which you can make a profit. If you cannot make money in stocks, then you will lose all your money quicker, much quicker with options. Tip number 2, understand fundamental analysis. The fundamentals of a stock do have an impact on the direction of a stock. You need to know what makes a company a good investment and what makes it a bag of garbage. Do not bet against the fundamentals. Tip 3. Time counts against you. You need to be sure before placing an options contract that the stock is going to move before the contract expires. you will look for more volatile stocks, or at least stocks with a strong trend and increasing volume. Tip 4. In the money options and out of the money options. Understand the additional costs of buying an option in the money as opposed to out of the money. When you buy an in the money option, it means there is already some intrinsic value in the contract. This you will pay for in the contract price. However, out of the money options are cheaper, but it does mean the stock price has further to move to hit the strike price and go beyond it before you start making money, and the intrinsic value of the contract has been improved. Tip 5. Understand calls and puts. A call contract means you expect the stock to increase and therefore seek a profit relating to the increase. When you buy a put option, it means you expect the stock price to fall and therefore realize a profit based on the decrease. This is rather like shorting a stock. You need to be sure of the direction of the stock. Buying calls and puts. If you are new to stock options contracts, you really need to be a buyer of contracts. In this way, you limit your risk to the amount you have bet on the contract. Unless you have expert professional skills, you should only be the buyer of contracts. Tip 7. Selling calls and puts. Don't do it. If you are the seller of an options contract, you have the benefit that time is on your side. Your goal is that the options expire worthless. Your reward is simply the value you get from the contract that you have underwritten and sold. However, beware. As a seller of contracts, you are taking a huge risk because you will need to pay out an almost unlimited amount if the stock skyrockets and you sold that call contract. Also, if the stock price plummets and you sold the put contract, you will also have huge liabilities. Tip 8. Don't get too complex. When you attend a seminar on stock options, they will fill your head with all sorts of complex strategies like vertical spreads, straddles, bull spreads, bear spreads, box spreads. If you make your trading complex, you will not make money. Keep it simple. Tip 9. Liquidity matters. Before buying any stock options, check what the open interest is. This means try to find out if there is a liquid market in the contract. There is nothing worse than buying an options contract and then you have the shock that it is immediately almost worthless because no one is trading it and no one wants to buy it. Tip 10. Profit volatility. Be ready for it. Be ready to see some serious fluctuations in the profits or loss on an option. Sometimes I've seen wild swings in potential returns. An option can show a 25% profit in a few minutes, only to show a 20% loss a few hours later. An option is a leveraged investment that magnifies your gains and losses. The bonus tip 11 is cash allocations. Do not place your entire investment pot on any single options contract. Use only a portion of your money on options, and of that portion, do not invest more than 10 or 20% in any single contract, preferably less. Remember, if your contracts expire worthless and you lose all your money, then you have no more chips and you have to leave the table. You don't want that. So in summary, options are a great tool for magnifying your rewards or protecting or hedging your current existing investments. But you really need to be a successful stock trader before investing in options. I hope you enjoyed this episode, and if you want a complete stock market investing education combining fundamental and technical analysis, risk and portfolio management to give you the knowledge to invest with consistency and confidence, check out our pro training with 16 hours of video and the Liberated Stock Trader book. Go to liberatedstocktrader.com/pro. Also, if you're looking for a great free introductory course, check out our free trading academy at liberatedstocktrader.com/register.